are joined from Bhavik Mehta from Century Financial. Thank you so much for joining me.
Thank you.
Let me ask you specifically about this inflation and PCE. In November, the core PCE rose by 4.7% year on year and 0.2% month on month, which shows a slowdown from the 4.5%. But any of this slowdown in the products and services slowdown is reflected in a continuation inflation in services specifically. So what does that mean, and what could that mean for the Fed and for the next step by them?
Right. So the last 3 to 4 months data of US inflation, I would say it's going to be very satisfactory for the markets in the immediate term. Major inflation gauges. So you're talking about the core PCE inflation, you're talking about the actual inflation numbers or even the PPI numbers. They are showing signs of cooling down. But having said that, the services part of the entire economic inflation, it still remains high. So what started with a goods-based, commodity-based inflation has fully, finally crept into the services side. Now it would be interesting to see how the services part actually reacts in the Q1 of next year, that is Q1 of 2023. So far, energy prices are taking a breather. We are seeing oil prices getting supported at in the 65 to 75 zone. But the US labor market continues to be very tight. The wages are still rising above the 4% annualized rate. So for the Fed, I believe they would like to see a lot of cooling down in the labor market, specifically to see the inflation below the near the 2% mark.
This continued strength in the labor market. This is the what Powell is looking at more than anything else. Is there any symptom or in the improvement in this market? I mean, do you think we want to see a worsening of, because the strength of the labor market is what is really taking us into this crisis related to inflation?
Right. So I would say the peak of the labor market is already behind us. There was a time, few months back, where we had for one job opening, one single job opening, there were like 3 people. So what's really happening is currently the jobs turnover ratio is standing near to the 2 level. So I would say the peak of the labor market is already behind us. What would be really interesting to see is how this thing actually shows signs of cracking. So if you look at the latest comment from Fed Chair Powell or even the most previous dovish members, they are expecting a sizable slowdown not just in the housing markets but also in terms of the labor wages. So they see that as the only probable solution for the inflation to come down. So what would be really interesting, what would be really worthwhile to see is how these things actually materialize in the first half of the next year. So, barring any major surprises on the energy side, so mind you, we already have just the last Friday statement where Putin declared that he's going to cut the oil production, exports by in the range of 5 to 7%. That immediately caused the rally in crude oil prices by 3 to 4%. So we are still living in an environment where anything could happen with crude oil prices. The risk of oil prices going towards upside is very high, and should that actually happen, it's going to be like another leg of big downfall for the markets.
If we look at the US markets, and there are still talks about whether that economy will get into a recession or not, and whether we will see soft landing or not, and the ability of the Fed to control inflation without further harm to growth of the economy. And we are approaching year end. So in your view and from your own perspective, how do you see Jerome Powell's performance this year and his struggle against inflation?
The Fed, if you look at the history of the Fed, it has always been late to react to what the data is actually telling them. So what started last year as a transitionary inflation is actually become a permanent thing. Now, I would say central banks, knowing what their function is, they are primarily there to perform that dual mandate of price stability, maximum employment, to see that the economy is not overheating or the economy not slowing down. So, if we're to rate the performance of Fed Chair Powell, I would say this year he scored very well in not shifting away from his hawkish stance. But again, he has highlighted the risk of overshooting very high or even cutting down the rates, even in an environment where the recession is. So I would say at this point of time, the Fed is right on track. Based on this year performance, the Fed has restored some credibility of itself, led by Fed Chair Powell.
But at this stage, no doubt, and many of us are still doubting the result that he could have achieved by, or he's achieving, I mean, Powell. So, what does success look like for the strategy that Powell and Fed are following?
At this point of
How do you
time,
describe it?
right. At this point of time, I would say they are on the right course. They are not budging away from their hawkish statements. They have clearly indicated that the economy should prepare, the market participants should prepare themselves for a sizable amount of slowdown. They have not outrightly indicated of a big recession or even hard landing. The strategy that they are keeping in mind is not to keep the market expectations very high. So, like few months back, everyone was talking about the Fed put, which is the level, the SPX level, maybe 3,000, 3,400, the level at which the Fed actually steps in and reverses its course. But markets, if you look at the current market document, the market literature, whatever the market news, no one's really talking about the Fed put. Everyone is talking about the recession and what's going to happen with the inflation thereon.
Bhavik, we saw the Fed going from 75 to 50 basis points, which means that it is still following up on the necessity of controlling inflation, but not as aggressively as we have seen. At the same time, in Europe, we see Isabel Stumble from ECB saying that there is no exaggeration and that they should continue to fight inflation very aggressively. So, how does it look like in Europe?
In Europe, the inflation started actually showing maybe 6 to 8 months late as compared to US. So it was pretty much obvious that they were way late behind the curve in adopting the very hawkish stance, being hawkish. So what has really happened is, if you look at the Euro USD prices, as soon as Euro dipped below the parity levels near to the point 0.6, point 0.7 zone, markets suddenly started discounting a very hawkish ECB, because just like Fed, the other central bankers who are late in the curve, specifically like someone big like ECB, they don't want to be too far behind the curve. So I would say ECB has been late because the data has been coming late. To be fair to them, knowing what the central bankers are, their goal would not just be guided by the economic policies of employment, price stability. They also have a component of market stability in mind. So we are talking about not seeing a big equity price decline. So this is where this entire hawkish re-rating again comes into play.
Bhavik Mehta, thank you so much for
Thank you.
having joined me today. Have a nice day.
Thank you.